Welcome to Inside Startup Investing, the only podcast where you can invest in every guest. On this episode, I will be speaking with the founder and CEO of Sphere, Alex Wright-Gladstein. Sphere has a climate-friendly investment fund built specifically for 401ks. While it may not sound revolutionary, think about this. Currently, there are pretty much zero climate-friendly index-like investment vehicles built specifically for 401ks that actually remove all fossil fuel related companies. There are millions and millions of people who are asking for something just like this in their 401k that represents trillions of dollars of potential assets under management for an investment index fund like this. You see, it may sound kind of trivial to essentially recreate the S&P 500 while removing fossil fuel related companies, but it actually turns out that building a low-cost investment-themed fund product for the 401k sector is extremely difficult. Like, you need tens of millions of dollars in AUM, a track record, heavy compliance costs, and oh yeah, you need to go through a deep audit process for 401k providers like Charles Schwab and Fidelity to accept you. When you dive into this company, you realize Alex and her team have already solved one of the hardest parts of building a new climate-specific fund product, with clear demand from millions of 401k holders. They've built the assets under management, gone through the years of audits, and created a model that works. Now this team has the opportunity to go chase trillions in potential AUM from some of the biggest employers in our country and the world, like Apple and Microsoft. The fact that Alex is leading the charge, investing her own dollars and time after building another company now worth north of $1 billion says a lot from my perspective about where this company is headed. So with that, let's get on to the show and welcome Alex. Alex, thanks so much for joining us today.
Thanks for having me.
Oh, it's my pleasure. So, Alex, you have a pretty interesting and phenomenal background and some real success to speak to as well, which I think is always great in a founder. Multi-time founders with real past success is definitely a great indicator. So tell us a little bit about yourself, your past success, and how you came to found Sphere.
Well, I've been passionate about turning around climate change really my whole life, ever since my 7th grade science teacher taught me about the topic. I couldn't really stop thinking about it, and I decided early in my career I wanted to be a serial entrepreneur, and I thought if I could help get technologies out of labs that could have an impact on climate, that could be worthwhile. So I ended up going to MIT for an MBA as an excuse to meet people across campus inventing things, which was amazing because there are over 300 labs at MIT that do energy-related research. I got to meet a lot of the people in those labs, and that's where I met my co-founders for my first startup. It's called IR Labs, and we're cutting the energy use of AI in half by using light to move data between chips. So we spun that technology out in 2015. And when we started offering a 401k plan to our employees in 2017, I asked for a climate-friendly investment option in the lineup, and it took over 3 years and a lot of persistence to get a single option for our employees. And that's what opened my eyes to this problem.
So can you tell us exactly what Sphere is?
At Sphere, we just make it easy for everyone to invest in a climate-friendly way. And it turns out that when I had so much trouble getting a climate-friendly option for our team, I wasn't alone. And when I started diving into it, I realized that it wasn't just other climate tech founders like myself looking for these options, and there are entire social movements at big companies, including Google, Microsoft, Apple, where people have been asking for climate-friendly options for years. They've gotten thousands of signatures on petitions, sent hundreds of emails to HR, and they haven't been able to get them for very similar reasons to why I, as CEO, asking service providers couldn't get it done. It turns out that the core reason is there are just a lot of lawsuits in the world of 401ks. And those lawsuits tend to fall into 2 categories. There are excessive fee lawsuits and underperformance lawsuits. And while there have been climate-friendly funds around for a long time that are fantastic, they have all been actively managed and so expensive funds. They're funds where people are actively picking stocks, doing a lot of analysis on the climate impact of companies, and it's just an expensive way to do it. And so, of course, it's going to be something that 401k fiduciaries are wary of adding to 401k plans when there are all these lawsuits for having funds that are too expensive in the plan or funds that are underperforming the market at large.
In terms of the fee structure stuff that you're hitting on, are there rules within a 401k of what the expense fees can be? And like, what are they suing for? Are they doing something wrong, or is there just like discomfort with it?
So it's interesting. The only real law that regulates 401ks is this act from late 70s, early 80s. The acronym is ERISA, E-R-I-S-A. And it really hasn't changed since then. And what it says is that employers have a duty of loyalty and a duty of prudence. And really, these lawsuits are all about how that has been interpreted over time. And that duty of loyalty has been interpreted to mean that employers have to make decisions based on the best interest of plan participants, of those employees. And that's a very common lawsuit there is, hey, if employers haven't, like as a company has grown, for example, to be really big, if they haven't used that market power to negotiate lower fees on their 401k fund offerings for employees, then they're not doing what's in the best interest of employees. And that duty of prudence just means they have to put in the work. So like they have to be paying attention to how the funds in their lineup are performing. And so if they don't have a process in place to regularly check in on the performance of those funds and notice if funds are performing worse than other similar options, and then have a process in place to replace those funds, then that's why they get hit with those underperformance lawsuits. So
Oh, wow.
it's interesting. There are these law firms that specialize in the type of class action lawsuit where employees sue their employers for this reason.
Huh. That's wild. So it sounds like they're weary of adding these kind of thematic funds because of potentially the expense ratios. So how are you solving this problem?
We launched the first climate-friendly index fund. It's just designed to check the boxes of what those 401k fiduciaries look for. And so it is priced on par with similar funds. So our first fund is called the Sphere 500 Climate Fund, and it's a U.S. large cap fund. That means it invests in the 500 biggest U.S. companies by market cap. And like other funds in that category, it charges very low fees. So we charge 0.07% as our net expense ratio. And so that's largely equivalent to other U.S. large cap funds. We're not charging a premium for being a climate friendly fund. And then we're 99% correlated to the benchmark that's usually used in that category. That's the S&P 500 index. And so that high correlation to the S&P 500 and the low fees just right off the bat give a level of comfort to those 401k fiduciaries.
And how are you selecting outside of the market cap? How are you selecting those companies to say they're climate friendly or meet those criteria?
So there are two things we do to make the fund climate friendly. We try to keep it very simple and transparent so people really understand what they're investing in. And the first thing we do is we don't invest in fossil fuel companies. So we screen out a few different companies. The biggest category we screen out is fossil fuel companies. We also screen out lead contributors to deforestation, weapons manufacturers, private prison operators, and tobacco companies. And so we're left with right now about 410 out of that top 500 list. And for those companies, we vote our shares to encourage them to do better on climate. And what we find is that when companies do better on climate, it also sets them up for long-term financial success. As an example, installing solar on a roof is an upfront investment, but after a 2 or 3 year payback period, companies are actually saving money for the rest of the time. And so we find that the financial self-interest of employees, of these investors in these companies, is very much aligned with the health of the planet as long as you're taking a long-term view to things, which when you're saving for retirement, you generally are not doing day trading. It is a long-term time horizon, so it aligns well.
Now what I want to understand is kind of adoption from investors. In my own personal experience, right, I've had 3 jobs in my career. The first one was through Fidelity. for our 401k, and the second two, including Kingscred that I founded, have gone through guideline. And with Fidelity, it was pretty much, here's the funds we offer, and based on kind of your risk level, you can pick them. And then through guideline, you quite literally use a slider that says like, here's, I want to be more open to risk, but potentially more upside, or I'm more conservative. And then it kind of just picks a basket for you. So in terms of driving adoption and actually getting people to invest in this fund, what's the trick? How do you make that happen?
So before I started Sphere, I had a lot of people tell me, don't even try to go into the 401k space. It is so hard to break into that space. We tried, we failed, like, don't even try. And I think it's probably a good thing that I started a semiconductor company. IR Labs, we do photonics. We're selling to the biggest companies in the world in the semiconductor space. And I had heard over and over when I was starting that company back in 2015, don't even try to break in. How are you going to break into this space that's dominated by Intel, AMD, and NVIDIA? And we did. And now they're investors in IR Labs and customers. And so having had that experience, I think made me maybe a little crazy and just thinking, hey, if I could do that, I can do this too. And so I went ahead and I found that they were right. It is extremely hard to break into the 401k industry. If you launch an ETF, you get automatically listed on all the brokerage platforms on day one of launch. And so anyone can invest, but this is outside of 401ks. No one can invest in ETFs in 401ks. The 401k platforms keep out ETFs in general. There are some rare ones that do add them, but it's this weird kind of, I think, anti-competitive behavior where they just don't let ETFs in and they only let people invest in things like mutual funds. So we didn't launch an ETF, we launched a mutual fund because that's what's allowed on the 401k platforms. And then we had to go and find customer demand on all these platforms and enough. Like for Fidelity, we had to get $25 million in Fidelity customer demand within 401k plans on Fidelity to be added to Fidelity. And it took 3 years to get to that point, but we now achieved that. And then we negotiated a selling agreement with Fidelity and we're live on the Fidelity 401k platform. And we've been doing that over and over again. We just went live on Schwab last week, which is the other biggest platform that also has some of the biggest 401k plans alongside Fidelity. So those two were just huge wins that were 3 years in the making. And we persevered, and I'm so glad we did, because now we're actually on the majority of 401k platforms out there.
Wow, that is huge, and major congratulations. I know those things are deeply complex and challenging and take a long time. Getting on there is the key to you being able to scale this. But then there's still the adoption issue, right? Of how do you get people to buy in? And like, I know there's a lot of folks out there who kind of set it and forget it. They start their job and then they kind of forget about it, right? Whatever they select, they select. So how do you make sure you're getting selected by those folks in their 401k?
It's so true. Like just the word 401k is one that makes people want to tune out, right? Like this combination of just like really boring, slightly intimidating, and so how do you get people to care? And when I was first thinking about starting Sphere, the first person I called was our now Chief Creative Officer, this guy, Doug Burnett, and he's incredible. He comes from a big ad agency background, and he had run campaigns for causes, for good, for nonprofits, kind of pro bono on the side, and had ended up getting billions of views on these campaigns, these ad campaigns he did without paying a single dollar for an ad. It was all through earned media because of just the power of his creativity. And so I called him up and I said, Doug, so there's this problem I've been kind of diving into, and it has to do with 401ks. And hear me out. I know this is a super boring topic, but it turns out 401ks can have a huge impact on the planet. There's $1 trillion invested in the fossil fuel industry, in the US fossil fuel industry, just from US retirement savings. And that makes up 1/5 of the market cap of the fossil fuel industry. And that money isn't getting invested from people who are making a smart calculation of like, oh, I think this is a good way to like earn more money. No, they actually have no other option. They're all forced to invest in this industry, and it turns out it's an industry in decline. And so they're losing money by investing in this industry. It's already been losing them money for the past 2 decades. It's been the worst sector to invest in the US. And so when I kind of told him this story, I was like, okay, so Doug, it's a very boring topic, but it turns out you can have a huge impact on climate. Do you think that we can grow this movement? You know, there's already this social movement of people at big tech companies who've been campaigning for this. Do you think we can spread the word? Because most people have never thought about the fact that they're invested in fossil fuels. And he got very excited about it. He was like, yes, I absolutely think we can sell this. And that was honestly the vote of confidence that I needed to decide to go ahead and start Sphere. And it's panned out. He's done an amazing job. We actually just partnered with a nonprofit called Stand.Earth to help actors who are members of the Screen Actors Guild petition to get their pension out of fossil fuels. It turns out that their pension has over $100 million invested in fossil fuel companies. And when we went to actors like Jane Fonda and Mark Ruffalo and told them that fact, they were not very happy about it. And so they've been campaigning to get that money out of fossil fuels for the past year. And when the pension managers didn't listen, they decided to go public with it. And we just launched this campaign a couple weeks ago, and already it's gotten over 150 million views, and we're just getting started. And so we're really spreading the word through these campaigns that we do with the creative leadership of our chief creative officer. And it's an amazing way to get a lot of earned media, and the social media followers of these people who have millions of followers learning about this issue for the first time. And, we're not having to pay for these celebrities to share it with their audiences, right? They just care about this cause. And so one of our ways of growing is just by spreading awareness of the issue through campaigns like these, because at the end of the day, it turns out 401k advisors, the fiduciaries on this plan, they just care about keeping their customers at the end of the day. They want to keep their customers happy. And so when they get requests for climate-friendly options, they pay attention and they try to get it done. And so really, if you can have this groundswell of demand grow, the industry will follow. And so we get on plans through customer demand. It goes to those 401k advisors. They add it. And then people who've never thought about their 401ks before, usually it's like set it and forget it on the first day of the job. These days, thankfully, employers auto-enroll employees, so you don't even have to log in on your first day on the job, and you'll just automatically start contributing. This is a topic that gets people to actually log in for the first time and pay attention to how they're investing their money. Because once they find out, wait a second, I'm invested in the fossil fuel industry, they start caring about their savings. And there's this really beneficial cycle where when they do log in and start paying attention to how they're investing their money, they actually oftentimes increase their contributions, or people who've never even participated start participating for the first time. And so we're not only helping the planet, but we're also helping set people up for financial health in retirement, which I love that beneficial cycle.
I think it's wonderful being in the or on the side of trying to change financial services. I've learned how hard it can be to change behavior and get people to even pay attention, right? That is certainly a challenge. So I think that education and awareness is going to go a very long way in getting you there. Now, as an investor, I'm like, I love the fee structure you talk about. It's extremely low. I mean, it's next to nothing, which is awesome. As an investor in potentially the business of Sphere, I worry about that from a monetization perspective. So at the very, very low rate that you mentioned, do you need billions of dollars to get to a scale where like you're actually even profitable? Like how do you think about scaling this business for Sphere, the business, to become a really valuable, profitable company?
So there are two answers to this question. The first is yes, we do plan to scale to billions of dollars in assets under management. And the reason we think that that is possible and very doable is because the 401k market creates access to that scale in a way that no other portion of the financial industry really does. And that's because there are these single plans that have tens of billions of dollars. The Google, Microsoft, and Apple plans each have around $50 billion in a single plan. And again, these are plans where there have been campaigns of employees asking for this. So once we do get added to a single one of those plans, we can get over $1 billion added to our first fund from that single plan. And we expect others to fall like dominoes once we're on one of those big plans, because we have heard benefits managers say over and over again, they compete with each other. for talent. And so if one of them is doing it, other ones are going to want to start doing it too, because this is an issue employees really care about. It's really a litmus test for employees to see whether their employers just talk the talk on climate or whether they really
Right.
walk the walk. And it makes them really proud to work somewhere. So one answer is yes, we do plan to get to billions of dollars of assets under management. The second answer, though, is we are in what we think of as kind of like the early Facebook phase of our business model, where this is our first product, and it's kind of like Facebook when it was just focusing on user growth prior to turning on ads. I think for the first decade of their existence, they actually didn't earn any revenue, and they just focused on user growth. Then they turned on ads and became a money printing machine. So this first fund is the lowest fee fund and lowest fee product that we'll ever offer. And that's because S&P 500 index funds are the lowest fee funds generally in the marketplace. But we'll be launching more funds, and those funds will be priced on par with their non-climate friendly equivalents, but those are higher priced funds. And so we're going to be making much higher margins on every subsequent product that we launch.
Understood. And when you think about selling this to Apple and Google and Microsoft, sounds like step one, you got to get listed by a Schwab or Fidelity or one of the major 401k providers. So now is step two quite literally putting a sales force in place to go and knock on the doors of HR to get them to offer this to their employees?
Yeah, it is, but it's somewhat HR and it's somewhat these external 401k advisory firms. And the ecosystem in this industry is really interesting, but we've been building relationships in that ecosystem for 3 years now. And so we're starting to become really known as the provider of climate friendly options for 401ks among the 401k advisors. Now, these are financial advisors who specialize in advising companies on what 401k fund options to offer employees. So we're going to the conferences where they are. We're making sure they know who we are so that when they get requests for climate friendly funds, they think of us. And then there are other people. There are ERISA lawyers. These are lawyers that just specialize in advising companies on how to make sure they don't get sued when it comes to their 401k plans. We're building relationships with those lawyers as well. We're speaking at events. We're speaking on panels and webinars. They're all getting to know us. And so that now that we are added to those platforms, the other step that we really need to do is we need to grow our assets under management. For these really big plans, they want to see us at least $100 million in assets under management in our fund before they can really consider us for their plans. So we've been working on growing our assets under management. It's been slow going because we weren't on the platforms, so people couldn't
Right.
invest. But it's starting, exactly, but it's starting to really pick up now. So we just reached $39 million in assets under management. And so we hope to be at that 100 million mark within the next year, and then just be able to go after all of the biggest plans at that point.
So 100 kind of unlocks the opportunity to go after the billions in many ways.
Exactly. That's right.
I think I already got a fairly good sense of this after having this conversation with you and understanding just the level of complexity that's in this market. But when you think about kind of your unique differentiator moat, you know, someone could say, right, and I think it's a lazy analysis, but someone could say, well, you're just removing the companies with fossil fuels. Can't anyone do that? Can't, you know, spider indexes do that and do the same thing? How do you think about what separates you in the market, or what's your defensible moat around what it is that you're doing?
It's funny. I actually held off on starting this company for a while because I was like, someone else has to be doing this. Or if they don't, like, they should. Like, it's wild. You shouldn't have to start a company to solve this problem. And it's such a huge opportunity. Why is no one doing it? And so I actually spoke with everyone across the market. And basically, you can divide the market, or, you know, the competitive landscape into two categories. There are the companies that offer climate-friendly funds that do a fantastic job. Those are the ones doing the actively managed, more expensive funds I talked about.
Yep.
And then there are the companies that are the really big asset management firms, you know, like the BlackRocks, Vanguards, Fidelities, that offer funds that have tried to jump on the ESG bandwagon because that was really popular for a few years there. It's kind of on the down and now. So with that first category, the ones who have been doing climate-friendly funds for years, some of them for decades, and doing a fantastic job at it, I literally spoke to people at those companies, some of them the CEOs, and they told me, look, we're just worried that we're going to that we're going to cannibalize assets from our more expensive funds if we launch a lower fee fund. Like, we understand, like, we haven't been very successful breaking into 401k plans, but we're just not going to launch an index fund because it will take assets away from our more expensive funds. So that was clear. They're not going to do it. Now, if you go to the really big asset management firms that have jumped on the ESG bandwagon, pulled way back on ESG ever since it's been on the down and outs, they have tried, and it's just become really apparent to the public at large that they don't actually care about climate change. First of all, when they tried to do climate friendly funds, they did it all wrong. They called them climate friendly, but they still invested in Exxon and Chevron. And if you just look under the hood a little bit, people are smart and they understand that this isn't what they're looking for. And I think the big asset management firms have really created a pervasive, reputation for greenwashing, and the public at large just doesn't trust them when it comes to climate friendly investing. And so we see that there's a really big void in the marketplace for a true climate friendly asset management firm, someone who can, both help you grow your money and protect the planet, and who you can just trust. And so it's really that brand of trust that we're building, especially as the generational wealth transfer, the great wealth transfer is happening, and millennials and Gen Z, et cetera, younger people are inheriting this money, they're starting to earn more and invest more, and we are going to be the go-to place for them to be able to invest with someone who they trust. And other companies could start and copycat what we're doing, and we would love for more companies to start operating in this space, but we know firsthand how hard it is to break into 401ks in particular. And so we do believe we have a strong moat just because of the 3 years behind us of really hard work breaking into that 401k space, and it gives us a really nice head start.
When you think about exit opportunities, do you see IPOing your business yourself? Do you want to be acquired? And if we're thinking about the acquisition side of things, are there any comps out there to give us a sense of how big this could be?
We are aiming for IPO, absolutely. And we do think that there's absolutely room for that. The big asset management firms of today are just not providing what younger people want. And so as those younger people become a majority of the market, which is already starting to happen, there needs to be a new big asset management firm, and we plan to be that firm, and we plan to IPO. And it's funny, there's kind of a similar or parallel strategy from my first company, IR Labs, and this one. When we were asked this question, we would say the same thing, right? We're aiming for IPO, but it turns out the same things that set you up for a successful IPO, which is growing your customers, growing the companies that you're working with, growing your presence in the ecosystem. At IR Labs, it was having partnerships with Intel and NVIDIA and AMD, with the goal of, if one of them really tries to acquire, you want to have others who are also interested in partnering, so you get counter offers, and that's how you get the bid moving up, so you get acquired for a higher price. And it's a similar thing here, right? Like, we're not just on Fidelity or just on Schwab, we're partnering with every company in the ecosystem, so that if there is an M&A opportunity, and if for some reason we decide to go that route, then at least we do it at a very attractive price because there's a bidding war. But we would rather stay independent and IPO because we really think that it takes a company with a moral compass who's going to keep doing the right thing. There are some comps. There was a company called Calvert Funds that had some great climate-friendly funds.
Yeah, I used to be invested in those.
Oh, nice. Yeah. And, they're actively managed, so they are more expensive. They got acquired by a company called Eaton Vance. That acquisition price is not public, but Eaton Vance acquired them really to up their ESG credentials. They called them the crown jewel of Eaton Vance right before Eaton Vance then got acquired by Morgan Stanley, and that acquisition price is public. And yeah, Calvert funds have started adding fossil fuels back into the funds now. So it's an example of, once you get acquired, it's harder to keep that moral compass when there's someone else, at the top. And you no longer have total control over how you operate. And so that's another reason we really would like to stay independent and IPO.
Last question for you here. For those who are on the line, they're thinking about investing, they're not there yet, what do you want them to know?
Just that I'm so excited about the potential for this company. I've already built a company that's worth over $1 billion, and I plan to do the same thing here. And I think the opportunity here is just as big, if not bigger, to really change the world and make it a better place.
If you liked what you heard on the show today, you can check out why Sphere received a 4.7 out of 5 and an investment from Kingscrowd Capital at kingscrowd.com. You can also currently invest on WeFunder as of August 2025. And as always, if you'd liked what you heard on the show today, please like, subscribe, and share our podcast wherever you listen so more investors like you can find us.